Hey, what's going on, guys? My name is Fernando Corona, and if you downloaded this PadSplit Deal Analyzer, it means that you came across me some way and some form, and I'm grateful that you're here because I'm going to break down the 3 ways that anybody really buys PadSplits. You either buy it under market value, you buy it at market value, you do the conversions, or you buy at the top where you're buying an occupied PadSplit. Okay, those are the 3 main ways to buy. Again, you're buying down below where the property needs rehab, it needs work, you're putting money into it so the property appreciates in value, and then you're refinancing, right? It's option 1. Probably can get the best deal in that scenario. Option 2, but that's more work, more risk, longer time horizons, things like that. Option 2 is you're buying an already fixed up property and you buy it conventional, DSCR, whatever type of loan, and then you are fixing that up and converting it by adding walls, adjusting the AC, putting in furniture, PadSplit conversion essentially. That's option 2. And then option 3 is you're buying an already approved and operational occupied PadSplit. Okay, those are the 3 ways. And we're gonna get into how to analyze in all 3 scenarios, so that way you know if you're making the right purchase for yourself and how to calculate that return on investment. Okay, this video will probably need to be updated in the summer. I'm shooting this in January of 2024. In the summer of 2024, PadSplit is looking at making some changes to their fees, which is totally going to change the game up. I'm gonna be honest, it's going to be a little more difficult, but in this case right now, PadSplit's fees are the same. They charge a 12% flat fee, 2.75% credit card charge, and then on top of that, if you're self-managing or if you pay a property manager, you can go ahead and input the change numbers there. Okay, we're going to get into it right now. So let's do it. All right, we're going to get into option number 1. Let me just explain from a big angle. So this side right here, this is where we're going to be putting in a lot of our assumptions when we're buying a PadSplit or we're refinancing one. That's going to be right here. This is going to be like our financing pieces if we're going interest only. And this is where we are going to be seeing what our cash ROI is, our total return on investments, includes appreciation, your annual cash flow. Here's where you can put your vacancy rate. So everything in orange pretty much is you can fill out. Over here is where you're putting all the different rooms. I only have up to 12 rooms. I've yet to see a PadSplit with more than 12 rooms. So this should pretty much cover everything. So everything in orange is what you should be filling in. And down here at the bottom, same thing. You got the items in orange. Property taxes, you may have to adjust. Let's see. So we're gonna get going. All right. I'm gonna take you little by little on the top left. I'm gonna take you through some realistic scenarios based off of what I'm seeing in the market right now. So, purchase price. Let's say you're buying a PadSplit that needs to be converted. Okay, it's a little bit more flexible that way. You can use a DSCR loan or you can use a conventional loan. You can buy it cash. There's multiple ways to go about this. So this is if you're getting anything back at closing. Down here, I'm gonna uncheck this. You only want to release these if you're gonna be buying cash or hard money. This video is not for cash or hard money. That's going to be the other video about how to buy cash or hard money and then refinance out. So I'm going to uncheck this, and you'll see a lot of my numbers change. So you don't have to worry about all this. I am going to hide this for now, so you don't have to worry about it. Okay. So you're not like, wait, what's going on here? If you ever see those hidden, the way you unhide, you just hit this down arrow, boop, and it unhides it. Okay. All right. So let's keep going. So as of right now, you buy it for $250, you got $35,000 of improvements, $7,500 in closing costs. You're gonna get $3,000 in seller credits. This is where I put the address up here. Total cost is $296, right, with your improvements. You buy it, all that stuff. Now, the reason why it's important to separate these two is because this $35,000 is not financed, okay? Only this is gonna be financed, right? Your closing costs are not financed. There's holding costs in this, which is the cost to rehab the property and get it launched and ramped up and rolling. So I try to include all those costs here. I also like, if this is up to you guys, you can include a initial funding to launch right here. This is optional, but I suggest it. I launched my properties and I didn't have $5,000 in the account when I was working with private money. So in the first 2 months, 3 months, we were not profitable. You got ramp up fees, maintenance fees, like paying for photographer and staging and all this stuff, right? So I didn't account for that in an initial funding account. So who had to pay for all that? Or like the first month or 2 months of mortgages, right? I had to pay for that, and which I was okay with. But if I would have had like $5,000 in there and I would have told my private money lender, hey, we're gonna fill this with $5,000 so it's like our initial funding account, then I would have absolutely been like out of pocket, like totally nothing. Learning lesson for me, I would for sure put $5,000 in this in the future. So when I'm talking to a private money lender, or if we're doing business myself, I know I'm gonna fund this business account with $5,000 at the start. All in, your total cost is $301,000. Down payment, we're gonna put 20% down on the $250,000. That's $50,000. Does the math for you automatically. The rate, conventional rates are not this high right now. Right now, you probably get a rate at 7.625. And 20% down if you got decent credit. Decent credit's like 720 or over. Maybe that you can get better on this. We're not gonna go interest only, so I'm not gonna check that. We're going principal and interest. This includes, without taking you too much, if you scroll up here, this formula, it does include the principal, interest, tax, and insurance, okay? And it includes PMI. So if you double click this, it'll show you all the cells that it highlights. This one, this one, this one, right? It shows you all the cells that are highlighted and taken into account. If this is ever under 20%, you'll see this PMI turn on. If you ever see that 15%, again, this is for a conventional calculator. If you know, hey, I'm putting 15% down, but it's hard money, you know, it's a different beast. This isn't hard money. This is conventional stuff that we're talking about. Conventional loan or a DSCR loan. So if there's no PMI, then just make that zero. If for whatever reason this is 15% down and you want to say, no, there's no PMI, make that zero, right? You get to make this however you want. Just be aware of the calculations. Vacancy rate, 10% vacancy rate is pretty reasonable. I think that's fair, you know, across the whole year or 2 years that you're owning these properties. How much are you going to be renting it out per week? There's a tool in PadSplit. All right, so it took me a little while to find this link. I'm not gonna lie, it's kind of hidden sometimes. If you want this link, I will put it in the PadSplit piece. Yes, I think it's gonna be pretty valuable. But basically, you can click in. So let's say we're going in Atlanta. Click into Atlanta. It gives you all the data, the units, active units, upcoming units, the demand. So then now we can look in each of these sections and say, all right, we got 28 active units. 89% average occupancy. There's still average weekly room prices. See, like the data is not perfect. So this is where working with your PadSplit rep is huge, right? But at least you can get average occupancy. So if you're looking in a specific area, like that one's 93% occupancy. See, this one's 60% in this postal code. So hopefully you're using as many tools as you can to help you make informed decisions, especially in your analysis, okay? So like I got one in Riverdale. You can just type in the zip code, 20331. 95% average. Yep, that's really, really solid performing property in there. Okay, this tool, I'll give it to you so you can use, but until they get it better, where they used to have this, I'm not sure what's going on here, reach out to your PadSplit rep, they'll give you that data. Okay, going back. So I am going to just tell you what my properties are doing, or what my property is right now. So I am getting 285. This one is like a 1-1 type of room. You know, another one's getting 205, another one might be getting 195, another one's like 185, another one's probably 72. Maybe you got, you know, a few in here that are 160s, and we'll say 165 or something like that. So this is pretty, you know, realistic to what we're bringing in. 10% vacancy. Okay. All in, right away when you're putting all your numbers in here, all your financing in here, and you put this stuff, the first thing I look at is how much cash out of pocket am I? Some people look at that and say like, well, yeah, that's a lot. I mean, I would look at that and say, yeah, that's a lot. So being aware of, you know, what's realistic and how much money you're gonna be putting out of pocket. Okay, $101,000 right now to do it this way. This is probably like a 2-month ramp up period. And here, I probably, see, it looks like I put 3 months here in terms of ramp up period. You can change that. If you're like, hey, I think I can ramp up in 2 months, you know, doing both rehab and the furnishing and then launching it and everything. If you think it's 2 months, you can make that edit yourselves, guys. This is just taking the mortgage payment and multiplying it by 2. The total cash outlay is what I estimate my total cash out of pocket conservatively is going to be. That's how I want to analyze deals, because if you're ever getting in the position of raising capital, then you want to make sure that you don't want to get caught telling them, and this happened to me, promising the world, oh yeah, we're gonna get in for 65 grand, it's gonna be amazing, and then, hey, I need more money, hey, I need more money, hey, I need more money, and then it creeps up, now it's 90 grand, and you're like, oh my gosh, you feel terrible. There's ways out of it. Obviously there's ways to help out, and I end up offering, you know, 100% of profits for the first 2 years up to a certain amount of money, and so that way they feel like, okay, I had to put out more money, but they're getting all the profits for the first 2 years. So there's ways to fix things, you know, and still keep your private money happy. But learn from me, know up front, under promise, over deliver. is a good thing to believe or to have. All right, so let's get into, so now you know this is what your total cash outlay will be. These numbers you're not looking at just yet until you come over here and you're getting your rental income. Let me just explain how this works. So one, the assumption is that every year rents will increase by 2%, and so will the operating expenses, right? Revenue and expenses, everything increases all the way over to 30 years. So it takes your total rental income, which is a $772.54, and the way you got that is you're just taking this information here. I am multiplying it. You're gonna see something weird. It's multiplying by 4.3. The reason I do that is because there's 52 weeks in a year, okay? There's not 12 times 4, right? Most people would say they would just do 12 times 4. So most people say, hey, there's 12 months and there's 4 weeks in every month, and that equals 48. It does not equal 52, right? The way you do it is you do a 52 divided by 12, and that gives you 4.333, right? So 4.3. In reality, you're taking your weekly and you're multiplying it by 4.3 to get the month. It's a rent by the week model. Okay, it's not a rent by the month model. It's a rent by the week. So you have to multiply by 4.33. If you don't, if you multiply just by 4, it's more conservative, but it's gonna make your numbers not as realistic. And like if I were to make this 4, then this number is gonna drop by a lot, which means that, you're passing up on potentially a good deal. 4,800 versus 5,168, right? So this piece adds up all this, and then this one adds up all this. And then if you just add those two together, down at the bottom right, 7,254. Same thing as on this monthly rent, 7,254. This is the gross revenue. So over here, rental income, this is your gross revenue. Then we take away the vacancy, and remember the vacancy rate's up here. Don't go changing the vacancy rate in here. You can see that it's pooling already from up there, and it tells you what your vacancy loss is going to be. Then you've got your gross income, and so now we got our gross income, and that's just taking this minus this, okay? This minus this, in this case it's plus because this is the negative, okay? So that's how I get to this number. Property taxes, I will say that you guys should edit this. This is a fixed property tax decimal that I got from Atlanta, from the zip code 1.37. You guys can change that. You can edit this if you want, property taxes manually. Just keep in mind that this is already included in the mortgage calculation, this one as well. So up here, the mortgage payment, see how it highlights both of these? You can see the dotted. That means that it's already calculated in the mortgage payment. So if you're curious, like, hey, does the mortgage payment include tax and insurance? It does, and it's grabbing it from here. Okay, so we've got property taxes. You can change that manually if you wanted. Insurance you definitely have to include those manually. These are annual. Just be aware, some of this stuff is paid annually and some of it is paid monthly. The annual premium, you don't want to put the monthly premium in here. And you don't want to put the annual in this. Okay, there's a whole method to the madness here. You don't want to ruin your guys' calculator. So you're putting in the annual in these two and then the monthly in these. And the reason we do that, again, because we are taking this information and plug it into this mortgage payment. Keep it in annual here. This will be in monthly. So we got property tax and insurance. Maintenance and repairs, you estimate $500 a month. So that's a total of $6,000 a year. And at times, we had one year it was only like $2,000, but the next year we had to replace the roof and that was $6,000, $7,000. So stuff happens. I definitely keep that in place. Sometimes when you're flipping a room, somebody destroys a bed or destroys a wall, so you destroys a floor. You have to make these repairs. Site visits, like there's maintenance repairs includes a lot of stuff that could happen on a monthly basis. Just buffering for that so you don't inflate your numbers is good. Utilities, $450. Over the summer, sometimes this went up to like $600. But then other months it can go down to like $300 or $350. So $450 is a pretty good average right now. Lawn care, $100 a month. Here's your administrative fee, which is 12% plus the 2.75. And it gets taken against after your vacancies. So it's not taken from the top number, it's taken from this bottom number here. And same thing with property management, right? Property management is taken from this bottom number after vacancies because that's what's getting deposited into PadSplit. Then we got PMI, your private mortgage insurance. It's not there, so you don't have to worry about it. If you had additional hazard insurance. So this adds up all your expenses. Property tax and insurance are not included in your expenses for the month because this is already included in your mortgage payment. So you don't want to double dip. case you're looking at this like, oh, why is it only adding these up? It's because these are already included in your mortgage payment, so I'm not adding them into your monthly expenses, your monthly operating expenses. All that happens is this gets translated over here. It's basically adding up the same thing as here. Your net operating income, it's just taking whatever your gross income is and then subtracting over your operating income or your operating expenses to get your net operating income. Just moving this down. So this is a cash flow quadrant. This is just taking that, dividing it by 12. And then at this point is when we subtract out the mortgage. So the reason why we separate the mortgage from your operating expenses is because your mortgage can change. If I change the interest rate, if you do a refinance and you refinance into 6%, you're going to see that mortgage change it. This mortgage can always be swapped. You can pay down the mortgage and all that stuff, right? But your operating expenses are going to be your operating expenses. They're different fixed items. Total cash flow in this example, $1,900. This is a good deal because if you look at your cash ROI, 22%. So to me, what is good? Yes, $101,000 is a lot of money. But when I go and approach an investor, bring this to them, or if I'm thinking about how to allocate my own capital, there's 4 ways of making money in real estate, meaning somebody's living in your property, paying down your principal balance. And then number 2 is appreciation. Like over time, your property is appreciating in value. Okay, that's number 2. Number 3 is you've got tax depreciation, which saves you from paying taxes on this money. So a lot of the money that I'm getting from our properties is non-taxable income, because we're leveraging the depreciation of the property that offsets the income. And so therefore it's like a paper expense. Even though I actually physically receive the money, the paper expense of depreciation, any investor should be using depreciation to offset the passive income, right? Passive income, passive losses. Depreciation is a passive loss. So you offset those two. Okay. And then the last one is the obvious cash flow. That's the 4th one. So when you think about what is good, the S&P 500, which is what everybody can put money into, right? S&P 500, collection of 500 like best companies, and the stock that you can just put your money in there. It's like a fund. Put your money in there and it allocates it and all that stuff. And then your money grows by 8 to 10%. But you only make money one way that way, okay? It's just value goes up, you sell. That's how you make money. So in my head, if you're getting even 10 to 12% of cash flow return on investment in real estate, it could still be good because you're still making money in 3 other ways. So for me, especially with rising interest rates, if I'm still hitting a 15% cash on cash return, like I'm still happy with that because I know there's other ways that I'm making money. That 15% with tax depreciation, it can be more like 18, 20% if I'm not paying taxes on that money. So that's a huge benefit, and then, so if I'm looking at something that's 22% cash ROI, then I'm really happy on that. This is where you have to balance. Like how much cash out of pocket versus what your ROI is. Would you rather have only $75,000 out of pocket and a 15% cash on cash ROI, right? This is where you start to play with the numbers. How could I do that? We'll get into that deal analysis when we talk about hard money. This one, just to recap, this is buying a property using a conventional loan or just straight up. You can use any type of loan, DSCR, conventional. You're buying the property, you're converting it into a PadSplit after you buy it, but you're not refinancing afterwards. You're just buying the property at whatever the value is, you're converting it into a PadSplit, then you're renting it out. That's this scenario. If we have questions on this one, I'm going to finish this video. The next video that I'm going to be going through is if you were buying an occupied PadSplit already, okay? And then the third scenario from there is we'll be going through buying it cash and hard money, getting the value up, and then refinancing, okay? So this is buying a property that is not PadSplit converted, so you are going to be converted to PadSplit. Just to recap, you're going to be adding rooms in there. Let me know what you thought in the comments, but hopefully this helps. All right, guys. What's going on, guys? All right, if you came across this, my name is Fernando Corona, and this is a PadSplit Deal Analyzer that we're going to be taking you through. Remember, there are 3 ways to analyze a PadSplit. You can buy it low, rehab the property, fix it up, convert it to a PadSplit, and then refinance. You can buy a property that's already renovated, and then you convert it to a PadSplit by putting up walls and adding furniture, or you can buy an already occupied PadSplit. In the last video, in the first one, we talked about option 2, which was buying it with like a conventional loan and then adding improvements. If you haven't seen that video and you think it's going to help you, there should be, in the description how to do that one. Okay, just as well as how to buy with hard money. In this video, we're going to be talking specifically buying an occupied PadSplit, okay? Meaning it doesn't need that much renovation, if any at all. Once you buy it, it's already going to be cash flowing. In these scenarios, I'm going to tell you how to analyze these deals so that you know what to expect. I'm a lender. If you need any help lending, reach out. I know how to buy and myself for all these strategies. Let's get into the video without further ado. So I got a deal right now. I'm working. You want to say hi to you want to say hi to my friends?
Yeah.
Okay, come on, say hi. They're over there. Hi.
Hi.
Okay. And this is pretty typical when you're buying occupied pad splits. The purchase price is going to be higher than the appraised value. This is pretty typical. Not by a crazy ton. I bought, right now we're doing one. Appraisal came back at 300,000, okay? Not 3 million. 300,000. You can't really, even though the purchase price was 320, okay, but the 20,000 is not financeable because we can only lend based off of the appraised value. Okay, there's usually caps. Either the cap's going to be a purchase price or the cap's going to be appraised value. Okay, here's a little hack for you. Let's say the purchase price was 290 and the appraised value came out at 300. Okay, something that I always recommend my borrowers to do is you can increase the purchase price from 290 to 300 and then ask for a $10,000 credit towards your closing costs. It decreases your cash to close. Unfortunately though, if you're buying a property for 320 and the appraisal comes in at 300, then you have to come up with that $20,000 out of pocket. That is not going to be financed, okay? In this example, we bought the property for, all right, Elena just walked in, said, what's up? So $300,000 is going to be financed. So that's the number we put here, because that's going to be the appraised value. So I have to go, okay, lenders, limited financing, and we just lost like 4 lenders that were financing pad splits this past year. And we're in 2024, right? So very limited to the type of financing we get access to. Closing costs, this is going to get up to like 13 grand, okay? A lot of the costs have to come out of you guys out of pocket. You can't really finance the origination. Your underwriting's more expensive, processing fee. You're going to get hit with an LLC review fee if you're closing in an LLC. It just gets more expensive because it's a business. It's a different type of loan. It's a business purpose loan. You can still get closing cost coverage if you want to do. In this case, it's not realistic because you're actually paying over. So this is going to go to 0. I still estimate you want a couple bucks in there. So 300 grand, $20,000, 3,000 in closing costs, right? $5,000 to launch. So total cost is 346 in this example. The down payment though is going to go up. In very rare cases can we buy with 20% down right now, but more realistically, when you're buying an occupied pad split, we're putting 25% down. Maybe as interest rates drop and we're in a different lending environment, that could go down to 20%. Right now, the good news is I'm literally quoting 8% to this client at 25% down. Big question is, are we using pad split income? Okay, we're still on the fence with appraisers and lenders on if we can use pad split income. So the good news is that I can use market rent income and go down, there's no DSCR options, or I can go down to 0.75 and still do 25% down. So there's a lot of ways that we're working these deals out. In this case, the market rents for this occupied pad split still get us to a 1.0 DSCR, which is why our interest rate is able to be 8%. This is super low in today's market, believe it or not. Just a month ago, I was like at 9.5. So this is good. Cash outlay is 120 grand, but there is no holding cost. So I'm going to get rid of the holding cost because there is no holding cost, right? This is cash flowing on day one. So you can go ahead and zero this out. And so usually what I like to do, by the way, if I'm being honest here, I duplicate the template. So that way, any adjustments that I make to this whole thing, and then I'll rename this property address. So 123 XYZ Street. If you guys see my sheet, I just have like a ton of these. And then you can easily go through them if you wanted to. Click this little button down here, and you just pick whatever street or whatever property you want to go into analyzing. So again, we're going to zero this out. Drops it to 113,000. We're financing 25% of 300,000. And that's how we get to this amount. So our $75,000 down payment. Maybe the numbers are still the same. It's still a 9.3. So your cash ROI is 16%. If you watched my last video, buying pad split. So we talked about this piece over here, revenue and assumptions. So I basically kept all the numbers the same as if we were buying it with a conventional. You're spending about like $10,000 more, but your cash on cash, adjusts a little bit, right? So it's not an insane difference, buying an occupied pad split or buying a pad split and then pre-conversion and then converting it. The biggest difference is going to be on, monthly cash flow. The other time we're getting 1,900 versus this one we're getting 1,600. Just sharing that with you guys. So I'll let you guys, make your decisions as you go about your process. One benefit, going conventional is your cash on cash, could be higher. I think we're hitting 20% or so buying it conventional and then doing the conversion. So that did increase my cash on cash. In some cases, like when we have lower interest rates, we'll be able to get to 15% down going conventional again. That's how my wife and I bought our first property, 15% down conventional using her income. That's going to be big as well. You can't buy occupied pad splits with a conventional loan right now. There's going to be underwriting flags it gets pretty nasty. And then right now, the sellers of occupied pad splits don't even want to go that route because that ends up wasting 30 days in escrow if things go south and all that stuff. We've tried to take people conventional first and then pivot to DSCR. Sellers reject that, so we end up having to just go DSCR all the time. Like I said, taking this similar to the conventional route that we had discussed. All this is the same as what we had discussed in that last video. So the key pieces is up here and how you approach the occupied pad split, right? And the items that I factor in, the things that I remove. So hopefully this helps you guys now as well on buying an occupied pad split and how to analyze that one. You're free to make adjustments. Again, just duplicate here and good luck. Okay, now we're getting to the last way that you can go ahead and acquire these properties, which could be the scariest to some newer investors, where you're buying a property that's beat up, you got to rehab it, you don't know what's behind the walls, you're going to lift up the floor and have to replace all the plumbing, and we had to spend an extra 15 grand to replace the sewer line from the central of the street to the house, and we didn't see that until the end. So it does get ugly, right? And it could get ugly, but for me it's worth the risk, because I was able to get into a 9-bedroom 3-bath for $76,000 and $90,000, which is not possible to do right now. You're going to be spending 101 to 120, sometimes even more. And our cash flow, because we bought it at a low price and we refinanced at the right time, then our cash flow is pretty strong, so we're gonna get into that now. How to buy with cash, how to buy with hard money, and then how to refinance afterwards. Okay, and so let's get into it. This line here, note, only consider unhiding rows 14 to 43 if you plan to use hard money to buy first and then refinance, right? If you plan to use hard money, just do that, or cash, buy first and then refinance. To open that up. So we're gonna check this box. All these numbers are gonna change. It's gonna look way different and it'll all make sense. We're gonna check that box and now turn on hard money or cash. Now the purchase price goes to down here. Okay, this is now gonna become our ARV, and you're gonna see some changes happen. So now let's go with the example. You buy a property for $200,000. If it's cash, hard money loan down payment. So how much of the down payment did you have to put in? So here you're gonna put 100% if buying cash. Okay. If you're not buying with 100% cash, your down payment's gonna change, right? What's your down payment? So 20% for hard money, then it's only $40,000 down. And so then it tells you the hard money loan purchase loan amount. So if this is 100, right? If we said you're buying this with 100%, you can see the hard money loan is 0. It means you're buying it with cash. Okay, if you're going 20% down, then now that adjusts your hard money loan amount on the purchase with your down payment. Then you've got rehab costs. Okay, so let's say you buy for $200 and you rehab $70,000. And the $70,000 is going to be to fix up the property, and it's also going to be furnishing the pad split, things like that. Now, for me, we did spend like $85,000, so I don't mind saying $85,000. We thought it was going to be $70,000, and then we lifted up the floor, and we're like, oh my gosh, we got to replace the sewage system from over there to over there. Again, this is all learning lessons, and so we ended up being $85,000. Rehab financing is your rehab finance? Is that going to be 100%? Or is that going to be 50%? How much of your rehab is financed? If none of it's financed, you're paying for it cash, then make that 0. If you got 20% down, we had our rehab I'm gonna say hard money points. If you're buying it cash, then you're not gonna have points. That could be 3%. Your interest rate right now could be closer to 11%. And then how long are you in the hard money for? 3 months. We were in our hard money for 3 months, and then we refinanced into DSCR afterwards. These LTC and LTV checks, this is really specific to hard money. if you're going to be buying with hard money, then looking to refinance, you definitely want to work with a lender who understands how to buy with hard money than how to refinance. Because some of the hard money lenders, they won't give you the money. A few things. They're not going to give you the money if they see you're building something that's not permanent, or they see you building something that wasn't according to the original scope. Because in order to draw money from hard money lenders, you have to send them a video, or they have to send an inspector to walk the property to see that the work was done. Okay, that's how hard money works. There's a link in the description on our hard money lending process for how hard money lending works. You guys can watch that if you're not aware. But you just want to make sure that you're gonna get paid out. Like, you're gonna get the money that you spend on your rehab. You're gonna be able to withdraw that. So working with hard money lenders who are cool with PadSplit is probably number one. And if you can't work with hard money lenders cool with PadSplit, and you're trying to navigate through like a different route, hey, you definitely want to be working with a lender, like a broker or somebody that knows how to guide you through the whole process, okay? So this LTC and LTV amount I've seen myself, because the lender I was working with is like, yeah, we can do 90% LTV. We can give you 90% of the purchase price and 100% of rehab and da-da-da-da-da. And they promised me the world. Then a week before closing, they're like, oh, Fernando, we need you to bring in the $30,000 at the closing table. And I'm like, oh, shoot. So then I had to go and raise another $30,000 of capital in a week. It's a whole mess, but it was fun because it was a learning lesson, and it put my back against the wall and I had to figure things out. So these LTCs and LTV checks are there to protect the lender. And so I put them there to protect myself of like what I need to be watch out for. This is sometimes 80%. I've seen that go up to 85%. And then LTV, this is sometimes 75%. So this is like and I kind of put it in there. What's the max loan to cost? How much does the total cost of the project? So the purchase price plus the rehab, they're only going to give you 85% of the total cost. LTV or LTARV, it's the same thing. Let's say we're only going to give you a loan amount that's max 75% of the future value of the property. So this is taking a test against 300,000. If I were to drop this to 250,000, you'll see that could fail because it's not passing the LTV pass check, right? But since this is 300,000, then now it passes because the total loan amount, 160. Okay, so you're taking the 160. This is the loan amount, 160 plus the rehab loan amount of 4250. Right, so you're taking these loan amounts and you're getting the total hard money loan amount, and then it's dividing that by the ARV. So that's how we figure this out here. So that's there to check you. If you see if the rehab goes up to 100%, you see that now it fails because the rehab costs 85,000. So that's where I would usually recommend, like, hey guys, we are going to drop our rehab cost. And so usually you take out the furnishings and blah, blah, right? This is when somebody gets a lender. You take out furnishings, you take out like the walls adjustments, you take some stuff out. So until you get to a number exactly like 50,000. See, it's worth 75,000. So then maybe now we go for 100% of rehab financing up to 55,000. That means you're gonna have to cover that $30,000 gap, but now you can get some money. Let's see if $6,000 passes. Yeah, so $65,000 passes, 65,000 passes. Okay, that's pretty good. So 70,000 does not pass. So we'll leave it at 65,000. That passes. We get 100% of rehab financing, and we can do 20% down. So on the purchase, we're able to get in for $58,43750 up front, including fees, doc fees. This might be, so 60 grand gets you into the deal. But remember, our total rehab was 85,000. So I need to make sure in the back of my head, I've got $20,000 ready to put in to furnish it and finish all that stuff afterwards, right? This is just purchase and then, initial rehab to get it up to the ARV of 300,000. That's what we're kind of saying here. Okay, total upfront cost, our rehab plus down payment, and total hard money loan, total into the deal including fees. So right now we're at 285,937. This is our total money into the deal. I always want to know how much total do I have into this deal, because that's going to tell me my total cash outlay. So upfront, understanding this piece is huge. I care about this number because that's going to tell me how much I'm saving, right, against the ARV. Remember, if the ARV we said was 300,000, you'll see it up here, 300,000. There is still, and this is funny that we put 20,000 here. Usually, if we're putting all the money, all the rehab funds down here, 85,000, then that would be zero. But since we need to put another 20,000, then you need to add another 20,000 here. After you do this financing, you're going to have to put another 20 grand. Closing costs when you refinance. you're not gonna have to pay probably $13,000. I would estimate like $6,000, because you already paid. It depends if you paid property taxes and insurance at closing, over there. Sometimes when people buy with hard money or cash, they don't pay for property taxes at closing. They don't pay 12 months of insurance at closing. Sometimes they do, sometimes they don't. This could fluctuate. To be safe, maybe I'll put $10,000 in that. So on the refi, because that's going to cover your escrows, your title, your lender fees, all that stuff. Okay, so you're gonna have to do another appraisal. Here, this is hard money left over. So remember that total amount, including fees, is $285,937. The difference between this number and this top number is what you're gonna be like credited. So initial funding to launch, we saw the $5,000 there. Total cost here is $321. In this example, you're gonna do a 75% cash out, right? You can get maybe not 8% on a refi, maybe 8.375 right now, or 8.5. So here's your total cash, $96,000. So we went through the three different scenarios. Scenario one was like $101,000. Scenario two, it was like $113,000. And then scenario three right now is like $96,000. And this obviously depends on how deep you buy. And you got your monthly rent and your monthly cash flow. Here's why I like this, and we kept this all the same. I like this strategy for a big reason, because your total cost here was like $321,000, but your value's at $300. So you're maybe, your $20,000, your all-in cost is $20,000 over $300,000. Whereas if you buy this property conventional and then you add, you spend another $30,000, $40,000, $50,000 to fix that property up and convert it to a pad split, the value of the home is still only, $230,000 or $250,000. I think it was $250,000. So if you add a ton of money on top of it, that doesn't add value to the home. So if you had to sell the property in a year, you could lose money, right? Because the value of the property is still only $250,000, unless you sell it as an occupied pad split, right? And then you could sell it for a little bit more. So I'm just thinking of different exit strategies. So buying an occupied pad split, that's option one. Going this way. In this example, going $96,000, you're saving from buying an occupied pad split. An occupied pad split world, it was like $114,000, and this is $96,000. So you're saving $18,000. Some people say it's not worth it, in this case. So that's where this is where you're making decisions when you're buying with hard money, you're buying with cash. Hey, I'm not gonna offer $200,000, I'm gonna offer $190,000. And at $190,000, now it's $86,000. So now your difference is, another, now it's $28,000, right? From the $114,000, whatever you're spending here, that's $27,000. Well, what if you picked it up for $185,000, right? This is how much you're saving. And then your cash outlay now becomes $80,000, and your cash ROI shoots up. So your cash ROI, 22%, but now you're getting into a property for $80,000. So a lot of this just becomes like, well, how deep can you pick up this property? What's the cash flow strategy you can use? What's my rehab going to be? That's why I like this buying with hard money or buying with cash model, fixing it up and then refinancing afterwards, because it becomes more of a game that you're able to control. Granted, I know the risk of the carrying costs and the time to launch, and then things go south during the contractors and all that stuff. So knowing how to build a team, definitely the first one, the second one, like I could see there being a good amount of risk. But once you get that third, fourth, fifth, if you get things rolling, then you learn, you build a team, and you build the trust. Then, we did pretty well and we did our first two, even though we did spend a little bit more than we wanted to. First one, again, we got in at $76,000. The second one, we got in at $90,000. And for us, in both of those scenarios, we saved $30,000 to $40,000. So for us, that was a win. Okay, that was us buying hard money and refinancing out. Took you guys through that process. The whole down piece over here is going to be the same. Initially, it's just, what's your strategy to get into the deal? Are you buying conventional and then you're gonna convert it to a pad split? Are you buying an occupied pad split? Or are you buying cash or hard money? Refinance out. Okay. Some people ask me, like, why can't we do 80% cash out? If you're doing an 80% cash out, this would change to 20%. You see your cash outlay significantly changes. Yes, and in a perfect world, you can do 80% cash out. I think as interest rates drop, maybe that's gonna be more possible. Right now, 75% cash out is definitely more doable. How could you do an 80% cash out? DM me or message me. There are strategies before you do the full pad split conversion where we could do an 80% cash out, okay? And then it could, that's where the conversation we could have, and it could be worth it, to be able to get another, 15 grand saved. Imagine getting into a pad split for $65,000. Like that would be That'd be sick. That'd be insane, right? 25% cash ROI, your monthly cash flow does go down, but your cash into the deal is a lot lower, which is pretty nice, right? It's that risk reward, up to you guys. Appreciate you for sticking around and watching this through to learn. If you are looking for a lender that's going to help you buy conventional or buy DSCR or buy hard money or refinance into whatever loan type that understands PadSplit, you have my number, 626-714-2440. Again, that's 626-714-2440. Shoot me a text, shoot me a DM on Instagram at It's Fernando Corona. Like this, subscribe. I'd appreciate it. This helps pay for my daughter's dresses and pays for my wife's coffees. So excited to work with investors. Looking forward to working with you guys.